Hello, everyone. This is Cathie Wood again, CIO, CEO of ARK Invest. And it's been a really revealing week this week, adding to our confidence dramatically. And so we'll go through fiscal and monetary policy again, go through some of the economic indicators, and then we'd like to talk a little bit about market indicators and then Bitcoin in light of Goldman's report this week. So on the fiscal policy side, not that much new. I did hear once again consideration of a capital gains tax holiday just for 3 months if you buy something within whatever 3-month period the administration selects that asset would be capital gains tax free for its life. I think this almost sounds too good to be true. And I do think the stronger the market is, the lower the probability it is that this will come through. But the payroll tax holiday or some variation on it is increasingly likely because the administration is noting that of those who are unemployed and are receiving the Paycheck Protection Program and or initial unemployment insurance claims. I'm not sure you can do both everywhere. That I believe it's 50% to 2/3 of the people receiving those funds are making more now not working than they made working. And so a lot of restaurants and retail establishments that are trying to bring their employees back are having difficulty doing so because I don't believe this program ends until the end of June and some parts end of July. So I think they're having to rethink how to get people back to work now, which is an interesting problem to have, especially since I think at the beginning of this, the fear was an outright depression. We had never shut the economy down completely. And so extreme measures were taken for an extreme circumstance. And now it seems that we're going to have to undo some of those measures in some way, shape, or form. In terms of monetary policy, I know that the Fed has now disclosed today. I have not seen the list myself, but they are disclosing the bonds they're buying. That's interesting, and they also have started to dial down the quantitative easing. In other words, I think both on the fiscal and the monetary policy sides, policymakers are feeling like, okay, now we have to get ready for the next phase, which is reopening and getting this economy back to work. So let's talk about the economy. I think a couple of shocking statistics, I would say shocking to those who have been expecting bad news to feed upon bad news. I think the most interesting one was new home sales. So new home sales, the expectation was that in the month of April, new home sales would be down to 480,000. That would have been down from 619,000 the previous month. Instead, they went up. This was April. This was in some of the darkest days, from 619,000 to 623,000. Now, true, on a year-over-year basis, prices were down. In other words, there were both sellers and buyers willing to move off the fence. Sellers taking a bit of a lower price, buyers taking advantage of interest rates and a decision to move out of the city, perhaps, both off the fence and keeping the housing market going. Very interesting. We did see today or yesterday pending home sales down 35% year over year. So the question there is, are people taking their homes off the market, or is there just a shortage of inventory evolving now? More demand, and yet the housing supply, certainly for new homes, has been hit here a bit. We shall see. We also got in the GDP revision this week, confirmation that residential investment, so the housing sector, was very strong in the first quarter. GDP was down 5% at an annual rate in the first quarter, but residential investment was up 18%. So the market was pretty much on fire going into the coronavirus crisis. And we're still seeing stronger demand than I think any of us would have expected at this point. Now, another interesting report came out today. We had personal income up 10.5% in April, and expectations were for negative, and that's because I guess most economists hadn't factored in the PPP program and other government supports. So this was purely because of those. We saw consumption, which is getting the hot headlines, down 13.6%. That's just a 1 month decline. That's not annualized. That's shocking. But when you get the combination of disposable personal income up roughly 10%, and consumption down nearly 14%, you have a skyrocketing in the saving rate. The saving rate went up to 33% from 13% the previous month and 8% the month before that. These are very high saving rates. Now, we understand why the saving rate started to go up, certainly in March. It was fear. The coronavirus, who was going to lose their jobs, who was going to lose their business. And I think today what it signals is, yes, concern, pulling in horns, but also what we're seeing in that saving rate is significant pent-up demand. I have a house full of young people here. They're in their 20s. My daughter and her roommates and friends getting out of the city. And I asked them last night whose saving rate had gone up. They all had gone up. And, they're all looking forward to doing exciting things. And it is mostly doing once they leave lockdown phase. So pent-up demand, yes. And then there was another very interesting statistic in the GDP revisions this week. So originally we thought inventories in the first quarter had dropped to 16 billion. Instead, with a revision, they dropped 65 billion. So remember, over the last few weeks, I've been saying businesses were not keeping up with consumption pre the coronavirus. That is proof positive of it. Now, whenever economists see these sorts of metrics, you've got the saving rate soaring. We've never seen 33% in history. I think you have to go back to 75 to see 18%. That was the last high ever. So we've never seen this before. So certainly some of it's pent-up demand if you use that 18% in a recession as sort of precautionary balances. And then you have inventories falling so significantly in the first quarter. Businesses had pulled back. They weren't keeping up with the consumption that was there last quarter. Can you imagine now if consumers start releasing some of this pent-up demand? The businesses aren't ready for it. They're not ready for it. So by definition, again, I've been through a lot of recessions, and by definition, a V-shaped recovery is caused because inventories are liquidating and not keeping up with consumption. We think that's what's going to be happening during the next few months here. That's very interesting. And then we got another number today. It was retail inventories alone for the month of April. So this is just 1 month to the next. And retail inventories dropped 3.6% from 1 month to the next. That's not annualized. So again, this idea that inventories in the first quarter had come down, and now you look at the retail space in April, they're drawn down at nearly a 40% annualized rate. So I don't know how economists are going to get away from this idea that we're not going to have a V-shaped recovery. The CBO, Congressional Budget Office, now thinks we'll see a 20% bounce in GDP. That is an annual rate for the third quarter. And we're slowly starting to see analysts and economists catching up with that notion. We have another clue that even the industries worst hit by this shutdown, the airline industry, which has been destroyed in the stock market, of course, they have they have funding. The government has backstop funding for them to the tune of $29 billion, should they choose to use it. They're not using it. They're not using it because for one of two reasons, or both. The first is it comes with conditions. One of them probably being that the government gets an ownership position in the airlines themselves, maybe through warrants, much like it did with autos during the 08-09 meltdown. So that might be one reason. But the other reason might be they are seeing airline traffic come back. Now, this is very slow comeback, but they want to see what's going to happen now during the heaviest traveling seasons, the vacations into the fall. They think, obviously, they might be able to get over that hump, which again, one of the worst hit sectors out there is speaking volumes. As far as the stock market behavior, very interestingly this week, we saw several days where value stocks took off. Financials on one day alone were up 7.7%. So we know there are value strategies out there. They've been lying in wait and continuing to build positions into these deep value spaces. As I mentioned in last week's video, we would tread carefully in these spaces. We think financials, energy, and any industry dependent on the internal combustion engine is going to be disrupted and disintermediated, perhaps severely so, during the next 2 to 5 years. But that doesn't mean we won't see these value surges. We would call them bear market rallies in a sense, certainly for those groups. And we know they look really cheap. And sometimes groups are cheap for a reason. So again, just tread carefully. We're sure there are some bargains and some incredible companies in the value space. But if they're in harm's way from a disruption or disintermediation point of view, we would be very careful. Then on to Bitcoin. Interesting to watch or to read at least the highlights of Goldman's report. We discussed it at our brainstorm today. And Yassine El-Mandra, who's our cryptocurrency analyst, and we're very specific when we say that, cryptocurrency analyst, because we do believe that cryptocurrencies are where the most value in the space will accrue over time. So you might think of that as market cap in the equity world. We call it network value in this world. And we think that the value will accrue to just a very few currencies. And we think the more than 2,000 crypto assets probably are not going to be that productive a place to invest. Seems as though Goldman has made that mistake, just putting cryptocurrencies and crypto assets together as one. We would disagree with that, and to put Bitcoin in that category, we would disagree even more vociferously. It was interesting to hear Yassine talk about, well, they don't think Bitcoin's behaves like a bond, and it certainly doesn't behave or have the properties of equities. And they went on, and Yassine's point is, that's right. it is a new asset class. They're claiming it's not, but effectively they're saying it is. So we found that interesting. And we certainly don't think they understand the network effects associated with Bitcoin specifically, nor the security of the network. The Bitcoin blockchain is the most secure blockchain out there. I don't think you get any argument about that from almost anyone who knows something about the space. And so one of the brainstorming topics or thoughts, I should say, is that, well, unlike with energy or power, where some of these banking companies, they actually were able to participate in the physical assets as they're trading their derivative books, right? So they would have as backups actual storage of energy on ships. They own the ships, or at least leased them, and just stored the energy in case they had to take physical delivery. And same with power. They owned some power utilities or had agreements with them. That's not going to be possible in this space necessarily, unless they get into Bitcoin mining. So let's see if they do. I think what we learned from this report is either they never will, or they're trying to figure out the best way to do it. We know that in the traditional world, anti-money laundering and know your customer, so AML, KYC, is a big consideration, and understandably so. And we've been interested to learn about a company, Yassine again mentioned this company, Elementus, which is working with regulators to try and help solve for this problem, develop compliance and risk metrics around this problem. And it might be, okay, we can trace, and you can trace transactions, but actually tracing that the last 6 transactions were not from, the illicit activity, but legitimate activity, and then going forth from there, being able to trace, again, legitimate activity with AML and KYC built into the ecosystem from a compliance point of view. So Goldman's report did set us up in Brainstorm for a good conversation. We were surprised they came out on this side of the argument, and we will be very happy to present the other side more formally once again, as we did in 2016 when we wrote a paper called Bitcoin, Ringing the Bell for a New Asset Class. That paper was with Coinbase, with the help of some of their data. And the paper that Yassine is writing with Nick Carter is using Coinmetrics data, which is premier data we know. So it will be partly updating that new asset class paper and adding to it. So we're looking forward to sharing that. Can never say when these papers are finally going to make it through compliance and editing and all of that, but I would say within the next month. And then maybe we will set things up for a debate with Goldman. I always find that brainstorming and debating adds new dimensions to both sides' understanding. So if any of you know the authors of the Goldman report, please let them know that we would look forward to a healthy debate in the next 2 to 3 months. And then this weekend, we have an exciting moment. Hopefully, we will have the exciting moment finally at 3:22 tomorrow when SpaceX's Crew Dragon takes off. We hear, according to the weather, that there's a 50% chance that it will happen, but it will be fun if it does happen, and then we can share our excitement with one another, perhaps next week at this time. So hope everyone's going to have a lovely summer weekend, and Looking forward to comparing notes on the Crew Dragon and Bitcoin and anything else you would like to. You can always catch us on our Twitter handles. Take care.